And so without further ado, I'll introduce Elliot Bainbridge, and he will talk to us about all of his work over the last 4 years, essentially. But 1 year of really intense stuff. Elliot, you're up.
Thank you very much, Ollie, for that nice introduction. Hello, welcome everyone. Thank you for attending my honours defence this afternoon. So the research that I was doing all year was into the use of advanced statistical models to forecast options prices. And so without further ado, let's jump into it. So the purpose of this presentation is I'm going to give you a flavour of kind of what I did throughout my research throughout the fall to the end of spring term. So we're going to have a look at what my research proposal was, any necessary background information that was required to understand the research that I did. We're going to have a look at some of the data sets and the data that I collected. Then we'll move on to the actual modeling, which is the main bulk of the research that we did. Have a look at all the models that we built, all the final models. And then we're going to do a bit of an evaluation of the research proposal and see how we did. So, the research proposal. So, my research aimed to create a statistical model that can be used to forecast future option prices on the Dow Jones Industrial Average Options Index using the fundamental variables of the Black-Scholes-Merton model. So what's required to understand this? Well, we're going to dive a little bit deep into what is the Dow Jones and the DJX index, what are financial options, what is the Black-Scholes-Merton model itself, how does that fit into econometrics and financial econometrics, and then we're going to have a little run through of what the related research was. So the Dow Jones Industrial Average Index and the DJX. It was founded in 1896 by two business partners, Charles Dow and Edward Jones, hence the name Dow Jones. And what it does is it tracks the performance of 30 largest publicly traded companies by market capitalization. And on average, it has about 400 million transactions a day across it. So the way that the Dow was calculated when it was first founded in 1896 was they added up all the share prices of the 15 original companies and just simply divided it by 15. However, in the modern day, with the introduction of complex financial engineering, that was no longer possible. So now what they do is they have what's called a current divisor, and they add up the share prices still of all the 30 listed companies, and they divide it by this number that you can see here, 0.147. So what that means is that if the share price of a company increases by the value of 1, Apple, for example, is a company listed on there, if that increases by 1, then that means that the Dow Jones is going to increase by 0.147. And what the DJX index is it's the options index of the Dow Jones, and it's represented by 1/100th of the value of the Dow. So the Dow's probably at about 34,000 today, 34.5. Divide that by 100, and that's what you're going to get as your value for the DJX index. A little plug, today is the 125th anniversary of the Dow Jones, so 125 years ago today, it was first traded in New York. Let's have a look at what are financial options. So an option is a contract that gives one party the right, but not the obligation to buy or sell a financial instrument, a commodity, or some underlying asset at a given price at or before a specific date. Now that's a pure definition of what an option is. There's two main types of options that we have. We have what's called European options and American options. The main difference between these two option types is when you can execute the option. In a European option, you can only execute it on that specific date that we talked about in the definition. Whereas an American option can actually be executed any time between when you purchase it and that specific date that's mentioned in the option contract. So the benefit of American option contracts is that if you are extremely profitable and you want to get rid of all your risk at that time, you can execute your options, take your profit away, and you don't have to wait until that specific date in the future when the value of the underlying asset could go up or down. So there are two types of option contracts. We have what's called a call option and a put option. Call option is when you believe that the value of the underlying asset is going to increase in value. Therefore, you purchase it at a specific strike price, and hopefully at that specific date in the future, you believe that the strike price is going to be lower than that current market price, and you would sell and make the difference between it. A put option is when you believe that the value of the underlying asset is going to decrease over your investment period. So at that point, you would hope that the current market price is below. So what you're doing essentially in this option is selling shares that you don't currently own, with the obligation to have to buy them back at some point in the future. So at the bottom here, I'm just going to move this quickly out of the way, just so we can see those equations. Shove it up there for a moment. So these are the profit equations that we can look at for how we're going to calculate call options and put options. So to calculate the profit on a call option, we're going to take the current market price, subtract it from the strike price that's mentioned in, because obviously with the call option, we hope that the current market price is above it. We're going to subtract the contract price, which is the option price that we're going to hopefully forecast in our research. And then you're going to subtract any closing costs, and these could be brokerage fees, transaction fees, stuff like that. And then with a put option, as I said, we're going to sell it, and then we're going to have to buy it back at some point in the future. So we're going to do the strike price minus the current market price, and then again minus the contract price and these closing costs. So what is the Black-Scholes-Merton model? Well, the Black-Scholes-Merton model was actually released in a paper by Fisher Black, Myron Scholes, and Robert Merton in 1773. The paper was called The Pricing of Options in Corporate Liabilities. And actually in 1997, they won the Nobel Prize for Economics for it. And the whole point of their research was to try and create a formula or a calculation that can be used to accurately calculate European call options. So we talked about what a European call was before. That's when you can only execute it at a specific date. And the call option is when you believe the value of the underlying asset is going to increase at some point in the future. So this is the equation here. Quite a complex equation, as you can see. We dived a lot deeper into it in my actual exam, in my actual paper. And we went through the proof of it. So there's some fundamental assumptions that are being made in the Black-Scholes-Merton paper that they talk about. There's 7 assumptions here. So I'm going to go through a few of them and talk about the specific details of them. So the first one is that the short-term interest rate is known and constant throughout the calculation. That's a given. That's hoping that, the risk-free rate that we currently talk about, hopefully that risk-free rate, we're going to model it on US bonds.
Would you please remove your mask?
Sure.
Completely. Thank you.
Perfect. Even easier for me. And the stock price of the underlying asset follows a random walking continuous time. What that essentially means is that we're unable to forecast future prices of the options and that the prices move at varying time intervals. As we said, it must be a European call option. No dividend payments available. No transaction costs for buying or selling the stock like we talked about before in those profit equations. And the last two, that it's possible to borrow any fraction at the constant interest rate and that there's no penalties for short selling. So how does this fit in? Well, the main field of study is called econometrics. So econometrics is the quantitative analysis of the actual economic phenomena that we observe. And what they hope to do here is take the theory that we all learn in the classroom in Econ 110 and 120, and we actually look at data from the real world and we see how those theories actually apply, see if they hold, and if they don't hold, why do they not hold? Financial econometrics is the analytical field of study within financial economics. This is where the BSM model fits within. And what we're doing here is we're looking with specific interest in capital markets, derivatives, and other advanced financial engineering topics. So some of the related research that we have. Obviously, we had the main point, which was going to be the pricings of options and corporate liabilities by Black-Scholes and Merton. We also had 2 really interesting papers that were kind of linked to each other, although they were done by different authors. The first of it being the effects of economic indicators on financial markets. That was more of a pure economics-based research paper. They talked about a lot of theory in there. Whereas the impact of macroeconomic indicators on stock market performance, the case of the Istanbul Stock Exchange, that was a great example of econometrics in the real world. Because what they did was they took a lot of the theory from that first paper, used actual data that was collected through the Istanbul Stock Exchange, and saw whether any of those theories about the economic indicators held. However, with the actual research that we didn't find that there's not much related research. There's not much scholarly articles, if I say that correctly, with regards to actual option pricing, other than that of Black-Scholes and Merton. let's have a look at the research that I did myself. So the data sets. So when we collected the data sets, we started in 2013, 1st of January, and we ended on December 31st of 2020. Now, when you're building models, it's typical for you to split the data sets into what's called a training data set and a test data set. And the reason that you do that is so that the training data set gives enough data points to provide an unbiased evaluation of the final model. So it is typical for us to split it 2/3 to 1/3. So the training set is obviously always going to be bigger so that we can see which model is the best. And after that, we're going to test it on our test data set. So when we collected it, we found that each day you're going to have several options available. All these options are going to have different strike prices and they're going to have different times to maturity. So in order for us to limit the amount of options that we actually had available on one day, we decided to only collect what's called near the money strike price options. And what this means is that it was plus or minus 5 points away from what's called at the money. And at the money is when the strike price is equal to the value of the underlying asset. So here's a look at the variables that we talked about, or that we used in our model, sorry. The first is the DJX option prices. That's going to be our dependent variable for our research. It's going to be the dependent variable in the model. And as we talked about in our research proposal, we're going to use the main variables that were used in the Black-Scholes-Merton model. These are all these here: strike price, time till maturity, the DJX index itself, the historical volatility of the DJX, and then the risk-free rate that they talk about in the Black-Scholes-Merton models, commonly in financial application, is we use the US government bonds. The reason that we do that is because we believe that the US government is never going to default on its payments of bondholders. So here's a bit of variable analysis. So what I've got here is the graph of 4 of the variables. The one on the top left here is the at the money option prices. Top right is the DJX index itself. Bottom left is 3 different time frames for the US government bonds: 3 months, 6 months, and 1 year. And on the right here, we've got the volatility of the DJX. The reason that I bring this up is when we do modeling, it's really important for us to think about 2 main things: their trend and seasonality. The reason that we think about those 2 things is because we need to determine whether the data is stationary or not. So in order for it to be stationary, we don't want any trend or seasonality. Now, trend pretty much means that if you connect the first point and the last point together and the slope of it isn't 0, it's going to have either a positive or a negative trend to it. Seasonality is a fixed reoccurring patterns in the data set. You're going to see it a lot if you analyze shopping data from places like Walmart or Hy-Vee. The reason that this is important is because you can see that there is definitely some trend in some of the data sets here. So that meant that we had to difference the data set by 1 when we were doing further modeling, such as our ARIMA models and our VAR models that we'll talk about later. So here's some important terms that I feel like we should understand before we actually go into some of the modeling, because it does get quite complex. Statistical significance. So this refers to the claim that a result generated by a test is not likely to occur randomly, but instead likely to be attributable to a specific cause. The reason that we talk about this is we want to know whether the variables included in our models are statistically significant at forecasting or helping to model the dependent variable. The R squared, so this represents the proportion of the variance for a dependent variable explained by the independent variables in the model. The AIC, well, this is a prediction, this is an estimator of prediction. We can only use the AIC when the dependent variables, sorry, that should be dependent, when the dependent variables are the same in the model. And finally, the root mean squared error, it's a measure of spread for the residuals in our model. So the 3 modeling types that we talked about in our honors research, first is the multivariable linear model. The second is what we call ARIMA models, autoregressive integrated moving average models. And the final one is what we call VAR models, or vector autoregressive models. Today, we're only going to focus on the multivariable linear model and the autoregressive, or the vector autoregressive model. This is mainly because in our research, the ARIMA models didn't produce any valuable results that we could actually use. So the first one, the multivariable linear model, what you can see on the left here is that we have all the independent variables that we talked about before that are used currently in the Black-Scholes-Merton model. We can see that all the variables are statistically significant here. That's shown by the p-value less than 0.05. We have a nice high R-squared value. The t-statistic shows that all the variable effects are significantly different from 0. That's probably not a great thing for us. But the t-stat and the p-value pretty much talk about the same thing. However, when we ran this model, there was an important error message that was shown, and that was that there could be high multicollinearity between some of the variables. Well, what is multicollinearity? Multicollinearity is the correlation between some of the independent variables. We don't really want correlation between independent variables. What we want most is correlation between independent and dependent variables. So we can check multicollinearity by running something called the variance inflation factor. What a fancy name for it, or the VIF. The way that we calculate the VIF is by running the models, running lots of different models, each with the independent variables that we talked about before as the dependent variable. We get the R-squared value, plug it in here, and we'll get the VIF. So as we can see, the adjusted Dow Jones Industrial Average, or the DJX, that and the strike price are highly correlated with each other. Now, at first, that kind of worried us, and then we actually thought about the financial application of it. We would be very worried if the value of the underlying asset and the strike price were not highly correlated with each other, because one is pretty much equal to each other, or one's tracking the other. So taking that into consideration, we didn't really think much about the multicollinearity, and we decided to move on. Then we moved on to what's called a log transformed multivariable linear model. So a log transformation can be used in a multivariable linear model only when the dependent variable is bound below by 0. Now, I talked about a case in my full research paper where option prices and futures prices actually weren't bound below by 0. But over the data set that we talked about, or that we have in our modeling, the dependent variable was bound below by 0, and none of the option prices went below 0. So let's have a look at this model here. We have a significantly lower adjusted R-squared. We have a standard p-value, all of them statistically significant, that's great. And we have the same result here with the t-stat. So then when we moved on to any of our more advanced modeling techniques, we found out that there had to be some form of data set manipulation. The reason for that was, as we talked about before, each day had several options with different strike prices and with different times to maturity. But when we run, for example, the VAR model, due to the mathematical makeup of the model itself, you can't actually have one date with several different options on it. You have to have one date with one option. This led to us building 2 different data sets from the full data set that we had originally. The first was DJX options that were at the money, which is shortest time to maturity. And the second was DJX options that were at the money with the longest time to maturity. So the shortest time to maturity pretty much means we took the option, let's say January 1st, 2013. The closest option to that, I think, was January 4th, 2013. So the time to maturity there was about 3 days. We took those options to build this data set. Whereas if we look at January 1st, 2013, again, for the longest time to maturity, it's about 70 days in the future. So when we were building our VAR model, the most important thing for us to do is to decide what the lag order was. So how do we decide what the lag order was? Well, we can run a series of VAR models, all with different lag orders, and we can use the AICs to determine which lag order is best. We're looking for the value with the lowest AIC, but as you can see from these results, the value of the AIC very close together. So in order for us to work with the most simple model, we decided to use a lag order of 1. So here you can see the summaries of the VAR models. The one on the left has the shortest time to maturity data set, and the one on the right, the longest time to maturity data set. Some important things for us to observe. First of all, in both of them, only the historical prices are statistically significant. We can see that by having a p-value less than 0.05. The AICs are pretty similar to each other, significantly lower than with the multivariable linear model. And the last thing that's going to be important in the future is look at the size of those coefficients for the volatility. Just remember how large those sizes are. So how do we determine which of the best models for our initial model analysis? Well, what we're going to do is we're going to calculate what's called the RMSE. So we're going to forecast over our training data set with each of the models. We're going to calculate the RMSE, and technically the one with the lowest RMSE would be the best. So as we can see, the OLS, or the log OLS, does pretty well on the shortest time to maturity data set, and it also does the best on the longest time to maturity data set. And we have very, very large very, very large RMSEs on the VAR data sets, on the VAR models for both data sets. So that led us to think, why? Why do we have such a high RMSE? Because going into it, Oli and I both thought that the VAR models would be the best model for this. So the reason for it was, Black-Scholes Merton paper is actually very vague when it talks about volatility. Originally, we had what's called a moving average volatility. So that's where we took one day at a time, calculated the historical volatility, and moved forward. That meant that at the start, our volatility values were very, very small. Hence, the very large coefficient you saw in the VAR model for the volatility. However, when you go miles towards the end of the data set, 8 years in the future, those values are starting to get a lot larger. Thus, the effect that that has on our models with those massive coefficients screws up pretty much our pricing. So taking that into consideration, we decided to remove volatility from our model, run the exact same test as we did before, where we calculated the RMSE over the training data set. And this is what we got. Most notable thing here is all of the RMSEs have decreased. And the biggest drop was in, there it is, the VAR models. The VAR models significantly decreased. Now, the lowest RMSE that we found was in the shortest time to maturity data set using the VAR model. So that's the one that we decided to use moving forward. So here's a summary. Again, we have to calculate the lag order. Again, the AICs are very close to each other. So we decided for simplicity that we would use lag order 1. At the bottom here, we can see a summary. All the values are statistically significant. Note that's different from when we did it before with the shortest and longest time to maturities. And the T-stat is significantly lower than it was in both of the longest and shortest time to maturities before. So let's have a look at some analysis. So on the left here, in the orange, you can see what our VAR model produced over the full data set. That's the combination of the training and test data set. And in the blue is the observed option prices that we had. On the right here, we can see the residuals. We can see we do pretty well in the middle section. We've got quite a lot around 0 or less than 1 to 0, but we don't really do well at the extremes. Let's have a look at the Black-Scholes Merton model, the one that won the Nobel Prize for Economics. We can see here, as it's known for undervaluing a lot of the option prices. And you can see on the right here, we can have these huge spikes. So over the full data set, again, we calculated the RMSE. The RMSE for the Black-Scholes Merton was about $1.26, and for our model was 0.93 or 94, rounded to 2 decimal places. And it should be noted that the range of prices for the DJX options throughout our whole data set was the minimum value was about 3 cents and the max being $10.39. So let's have a look how our final model did. So we were aiming to forecast 10 days into the future and have a look at how our model did against observed market prices and also the Black-Scholes Merton model. So for those of you with keen eyes, you can see our model doesn't do a great part here in the intermediate days. That's because our model is only optimizing for that 10th day forecast. It doesn't really care about everything else in the middle. Whereas if we look at here, the observed price was $2.80, that's signified by the blue line. Our final model forecasted it to be $2.96, whereas the Black-Scholes Merton model forecasted it to be $1.60. So we can see that our model did a significantly better job forecasting over a 10-day time horizon than the Black-Scholes Merton model. So let's have a look at what we've talked about throughout this lecture, or throughout this presentation. But we looked at the necessary background information. We talked about options, the Dow Jones Industrial Average, financial econometrics, and econometrics itself. We talked about 3 research papers, the main one of those being the main one of those being the one published by Black-Scholes and Merton that won their Nobel Peace Prize in '97. Then we looked at the different models that we had created, the VAR models, the ARIMA models, and the multivariable linear models. And then we did some analysis of the final model. That was our VAR model without volatility in there. And we did some analysis on how it stood up against observed market prices and how it stood up against what the Black-Scholes-Merton model would produce over the same time frame. So thank you very much for attending my honours defence, and I welcome any questions that you have.
We have 2 questions from online. The first question refers back to slide 21. Feel free to go back to 21. And the question is, what is lag order?
That's a good question. So lag order refers to how many timeframes backwards we're going to look at when we are building our model in reference to the variables that we're going to use.
As long as you're on this slide, could you tell us a little bit more about VAR? How does that work?
Yeah, so VAR models are probably my favorite form of modeling from the ones that Oli and I have learned about. And the reason for that is the VAR models are what's called bidirectional, which means there's no actual there's no dependent variables. All the variables are collected together and all of them are used over the whole time frame to forecast one another's next value. So that's the reason that we thought it would be the best, because in a standard model like the multivariable linear model we looked at, all of the independent variables are only used to forecast that one variable. So we can't really see how the change in effect works in relation to the dependent and independent models. Whereas with the VAR model itself, we can actually see how those relationships work because there is no kind of dependent variable.
So Elliot, quickly for the red.
Yeah.
Elliot, for the layperson. So a VAR model is attempting to backtrack in order to tease out cause and effect. Like you regress backwards to tease out causal relationships between variables.
A little bit, yeah. So the reason that we use, a VAR model is the bidirectional, which means that there isn't a specific dependent or independent variable. So all of them are being used together. When we're selecting the lag order, that's exactly what we've just said, or sorry, what you've just said.
Okay, thank you.
All right, are there any other questions of the non-committee members?
Does that mean I can run?
Not yet.
Sorry.
Go on, Robert.
Right.
So you talked about how your model is like optimized for every 10 days. Is it possible, or would it work similarly or the same if it was for every, say, 2 or 3 days or 5 days? Or?
So it's not that our model is optimized for every 10 days. It's just that it's optimized for 10 days from when the data set ends. So if we wanted to, we could just change the decimal in the code that we've written for it to be 1 day, 5 days, 30 days if we want it to be. But the whole point that I was trying to make with that last slide with that graphic is, as you don't see the jumping around that the actual option price has. And that's because our model is just trying to optimize for that 10th day, not for any of the intermediate days.
The short answer is yes. And Lisa.
Sorry, no, nothing. But you talked about RMSE a lot. Can you explain that a little bit more? What is it? How do you track it?
Yeah, so RMSE stands for the root mean squared error. The reason that we use the RMSE quite a lot in this research is because quite a lot of the times we've either manipulated or there isn't a dependent variable in our models, which means we can't use an AIC because the dependent variable has to be the same in those models in order to compare it by the AIC. So the RMSE is a calculation that we can do. but I hope you guys online can see it. And it's actually backwards the way that we calculate it rather than the way that we read it. So first of all, we're going to calculate the error, and that's the difference between the observed market prices and the fitted values of ours. Then we're going to square it so that all the values are positive. Then we calculate the mean of it, and then we square root it in order to get back to the original metrics. So yeah, so it's a way for us to measure how good our model is over lots of different model types that may have different dependent variables, may have different, whether it's a VAR model or an ARIMA model or anything like that. If there's any transformations on it, we can still use this throughout it.
So Elliot,
Mhm.
as a non-participant in this research, as a interested party, because I've been able to follow you with a golf ball find for most of your career at Cox. Before I helped Casey this year. How do you feel about what you've done? How good is what you've done? I don't care about these other people
Yeah.
necessarily, and what your research group is going to say. I want to know how you feel about what you did.
That's a good question. I'm very proud of the work that I've done and the whole my committee has helped me with. There was a few things that I kind of said at the outset that hopefully that's continued through. So the first thing that I said with our first meeting with Oli, I think it was actually in summer of last year after my junior year, was when I write my research project, I want it to be able to be understood by the layman. So that means that I want someone like yourself or Annalisa or, no offense, Professor Barbara Tennant-Smith.
No,
I want someone who hasn't got a mathematical or a modeling background or an economics background to understand what I'm doing, and hopefully they'll be able to gain something from the research. So I guess I'll hear in a few minutes from what my professors say, whether I've actually accomplished that. The other thing that I'm really proud of in this is that Oli and I have successfully learned another computer programming language. So we were both Oli was very proficient. I was pretty proficient in our statistical software, but we made the decision at the start of this that we were actually going to do all of the coding in Python. So I was starting from scratch. Oli was starting from a good knowledge base, but there was definitely several times that we wanted to put our hand through the computer screen and ask it why it wasn't working. But that's another thing that I was really proud of. In relation to the results of the model, I think we can be really happy from the results of it. I was skeptical at the start. Obviously, you've got this famous Black-Scholes-Merton model. You learn about it in Professor Hastings' advanced financial maths class. You think it's some form of the holy grail in finance. But actually, to create a model that's better than it, I'm not sure what the implications of being better than it is, but
Nobel Peace Prize.
I would say maybe you should start learning Swedish.
but we'll see. But no, I was very proud throughout the research. It's kind of emotional when I finished it about a week ago. So, yeah.
Thank you.
I don't have any tears in there. Carol, go ahead and unmute and ask away.
well, thank you very much, Elliot. It's very impressive. Lots of, amazing efforts putting into all of the stuff here with mathematics and modeling. But who would use this? Why, who would use this model? What would somebody do with it besides just this wonderful exercise of figuring out, does it do the prediction? So could you just talk about that for just a moment?
Yeah, I actually sat down for about an hour and a half yesterday afternoon trying to work out why someone would actually use any of the research other than academics. So I think the main purpose of the research, or the main use of the research, the application of it, would be to, like the Black-Scholes-Merton model, determine whether option prices that are available in the market are under or overvalued, given what you forecast for the future of the underlying asset. So if you find that an option, a call option, let's say a European call option, is significantly undervalued, then you actually may want to buy that in your portfolio rather than buying the actual underlying asset, because you're getting rid of a lot of risk in that portfolio. Because even if you're wrong about forecasting the future with regards to the underlying asset, as we talked about with financial options, you don't actually have to execute them. The only thing that you would be left with there is paying the prices in relation to the option. So yeah, so I think the main use of it would be to determine if market prices are under or overvalued, and then what effect that has for the risk potentially in your portfolio.
Thank you. That's a good answer, but it's, thank you very much. Good luck.
Thank you.
Any other questions? All right, in that case, I want to thank all the visitors, the non-committee members for showing up. I really do appreciate, I'll look this way. I really do appreciate you spending your time just listening to Elliot talk. Hopefully it was very edifying. Elliot, if you would stay for the actual grilling, I mean, for the questions from the committee, and if the committee could also stay, I would appreciate it.